This is a candlestick, a single bar on a price chart representing 1 week of trading in the gold market. The bar has a body, the distance between where price opened and where price closed. It has wicks, the high and low points reached during the week. Simple visual language that traders have used for over 300 years to read market psychology. This particular candlestick, formed during the week ending January 24, 2026, measures 11.4% from low to high. The body, the distance between Monday's open and Friday's close, spans 8.7%. The candle is green, meaning price closed higher than it opened. The body is large relative to the wicks, meaning conviction was strong throughout the period. In technical analysis, this formation has a name, a mega candle. Not an official term you'll find in textbooks, a colloquial term traders use when a single period's price action exceeds normal parameters so dramatically that it signals something beyond ordinary supply and demand. A candle so large it rewrites the chart's entire structure. The last time a mega candle of this proportion appeared on gold's weekly chart was September 2011, when gold broke above $1,900 for the first time. Before that, January 1980, when gold spiked toward $850 during the Hunt Brothers silver crisis. Before that, August 1971, when Nixon closed the gold window and ended dollar convertibility. 3 mega candles in 55 years. Each one marked a generational shift in gold's monetary status. Each one preceded moves that turned modest positions into substantial wealth. The 4th mega candle printed last week. And if the pattern holds, if history offers any guide to what follows these technical formations, the $50 position that seemed speculative on January 1st could be worth $5,000 by March. Not because of prediction, not because of hope, because of what the chart says about the forces now acting on the gold market. Forces so powerful, they're visible in a single week's price action, compressed into one green bar that rewrites everything analysts thought they knew about gold's trajectory. Here's what they're not telling you. Technical analysis gets dismissed by fundamental investors as reading tea leaves, finding patterns in random noise, assigning meaning to meaningless fluctuations. The criticism has merit when applied to minor chart formations, where sample sizes are small and pattern recognition suffers from confirmation bias. But mega candles are different. They're not subtle patterns requiring interpretation. They're obvious dislocations visible to anyone who glances at a chart. And their rarity, 3 occurrences in 55 years, means each instance provides genuine information about market conditions. The information a mega candle conveys is simple. Something changed. Not gradually, not incrementally. Something changed so fundamentally that a single week's price action exceeds what normally takes months to unfold. The January 24th candle closed at $3,147, up from the previous week's close of $2,891. A $256 move, 8.9% in 5 trading days. For context, gold's average weekly move over the past decade is 1.1%. The mega candle delivered 8 times the normal weekly volatility in a single bar. Volume confirms the signal. Gold futures volume during the mega candle week reached 847,000 contracts, the highest weekly volume since March 2020's pandemic panic. But unlike March 2020, when volume spiked amid chaotic liquidation, January 2026's volume accompanied a directional move. Buyers overwhelmed sellers with conviction that shows in both price and participation. The technical community noticed immediately. Within 24 hours of Friday's close, over 40 technical analysis services published alerts flagging the formation. The language varied: breakout confirmation, momentum ignition, structural regime change. But the message was uniform. Something significant just happened. The significance lies not in the candle itself, but in what typically follows. Historical analysis of gold's previous mega candles reveals a consistent pattern. The initial spike represents approximately 15 to 20% of the total move that follows. The mega candle is not the destination, it's the announcement that the journey has begun. If the January 2026 candle follows historical precedent, if the $256 move represents 17% of the eventual rally, matching the average of previous instances, the total move measures approximately $1,500. From the candle's opening price of $2,891, that projects a target near $4,400. But previous mega candles occurred in different market structures. The 1971 candle preceded a move from $35 to $850, a 2,300% gain over 9 years. The 1980 candle marked a terminal blow-off top, followed by a 20-year bear market. The 2011 candle preceded a correction, then a consolidation, then the current bull run. Each mega candle's aftermath depended on underlying conditions. The chart signals that something changed. Fundamental analysis determines whether the change produces sustained trend or exhausted reversal. This is where the lie becomes unsustainable. The January 2026 mega candle formed against a fundamental backdrop that previous mega candles didn't share. The 1971 candle reflected a singular event, Nixon's policy decision. The 1980 candle reflected speculative excess in a single market. The 2011 candle reflected post-financial crisis monetary expansion. The 2026 candle reflects simultaneous failures across multiple systems: LBMA settlement breakdowns, COMEX delivery stress, Shanghai inventory depletion, paper physical divergence exceeding 30%, central bank accumulation at record pace, and sovereign de-dollarization accelerating globally. The previous mega candles had single causes. This mega candle has compound causes. The technical signal is identical. The fundamental support is dramatically stronger. The paper versus physical distinction explains why this mega candle may exceed historical precedent. Previous gold rallies occurred when paper and physical markets functioned as a unified system. Arbitrage kept prices aligned. Delivery mechanisms worked. The gold price referenced a commodity that could be bought and sold at quoted levels. The 2026 mega candle formed while paper and physical markets are actively diverging. The $3,147 close represents paper gold, COMEX futures, LBMA spot, the benchmark quotes that financial data reports. Physical gold, actual metal available for immediate delivery, trades at $4,100 or higher in global markets. The mega candle's true magnitude is understated because the chart plots paper prices. If charts plotted physical prices, the candle would be even larger, the divergence adding another $950 to the weekly range that technical analysts are evaluating. When paper and physical reconverge, when the chart price adjusts to reflect delivery reality, the candle's message becomes clearer. The 8.9% paper move understates a physical market that moved approximately 15 to 18% during the same week. The mega candle is bigger than it looks. The $50 to $5,000 opportunity lies not in gold bullion, but in the instruments that leverage gold's move. A 50% gain in gold, from $3,000 to $4,500, produces a 50% return for physical holders. That same 50% gain can produce 500%, 1,000%, or more in leveraged instruments that amplify gold's underlying move. Mining equities offer the most accessible leverage. When gold rises, mining company profits expand faster than the metal price because their extraction costs are relatively fixed. A mine that costs $1,200 per ounce to operate earns $1,800 per ounce profit at $3,000 gold. At $4,500 gold, that same mine earns $3,300 per ounce, an 83% increase in profit from a 50% increase in gold price. The leverage compounds in junior miners and exploration companies. A junior miner with marginal economics at $2,500 gold becomes highly profitable at $3,500 gold and potentially transformational at $4,500 gold. The same percentage move in gold can produce 10 times the percentage move in equity value for companies on the margin of profitability. The math works in both directions. Miners fall faster than gold during declines. But during confirmed uptrends signaled by mega candles, the leverage creates asymmetric opportunity. A $50 position in a carefully selected junior miner at the start of a gold bull run can genuinely become $5,000 if the bull run reaches historical proportions. When institutions do what they're doing now, they're not speculating. They're positioning for mathematical outcomes the mega candle predicts. At 11 a.m. Eastern on January 27th, 3 days after the mega candle closed, Sprott Asset Management filed a 13F amendment showing a 340% increase in junior gold mining equity exposure since December 31st. Sprott manages $28 billion in precious metals-focused assets. Their analysts are among the most sophisticated in the sector. When they increase junior miner exposure by 340% immediately following a mega candle, they're expressing a view about what follows these formations. The filing detailed positions in 47 individual mining companies, ranging from large-cap producers to early-stage explorers. The weighted average market capitalization, $420 million. The typical junior miner that retail investors can't access through index funds or ETFs. VanEck, the sponsor of the GDX and GDXJ mining ETFs, published a research note on January 28th explicitly referencing the mega candle. Technical formations of this magnitude historically precedes sustained sector outperformance. We believe current conditions support overweight positioning in precious metals equities, with particular opportunity in development stage companies approaching production decisions. Development stage companies approaching production decisions. The exact category where leverage is maximized. A company that spent $200 million developing a gold deposit but hasn't yet produced an ounce operates at the sharpest point of gold price sensitivity. Their net asset value calculation depends entirely on the gold price assumed for their future production. Every $100 increase in gold price adds millions to their theoretical value. These companies, the developers, the near producers, the juniors transitioning from exploration to mining, are where $50 can become $5,000. Not all of them, not even most of them. The sector is littered with failures, frauds, and disappointments. But the subset that succeeds during a mega candle confirmed bull run produces returns that seem implausible until you see them in your brokerage statement. Less than 60 days remain in the window that mega candle analysis suggests offers maximum opportunity. The historical pattern shows that the majority of post-mega candle gains occur within the first 2 to 3 months of the formation. Early movers capture the momentum phase. Late movers chase extended prices. The January 24th candle establishes the pattern's origin point. March 24th, 60 days later, represents the historical window within which leveraged instruments typically achieve their maximum percentage gains relative to the underlying move. After 60 days, returns typically moderate. The initial thrust exhausts. Consolidation begins. The opportunity shifts from momentum capture to position management. The life-changing gains, the 10x, 20x, 100x returns that mega candles enable, concentrate in the first 60 days. The countdown is not arbitrary. It's derived from studying previous mega candle aftermaths, measuring when leveraged instruments peaked relative to the candle's close, calculating the average window of maximum opportunity. 60 days is the historical median. Some opportunities extended longer, some exhausted faster, but 60 days captures the core of the pattern. While charts signal fundamental support, the mega candle didn't form in a vacuum. It formed against a backdrop of systemic stress that provides fundamental justification for the technical signal. China's gold export ban, removing 800 to 1,100 tons of annual supply from Western markets, creates fundamental scarcity the chart reflects. LBMA settlement failures, revealing that paper claims exceed physical backing by ratios approaching 150 to 1, creates counterparty fear the chart reflects. Central bank accumulation at record pace, demonstrating that the world's monetary authorities are positioning for gold's rise, creates sovereign demand, the chart reflects. The mega candle is not predicting these fundamentals. The mega candle is registering them, translating fundamental developments into price action that technicians can measure and analyze. The synergy between technical signal and fundamental support is what distinguishes high-probability mega candles from false signals. A mega candle without fundamental support might represent speculative excess, a blow-off top like 1980. A mega candle with fundamental support represents a trend initiation, a regime change like 1971. The 2026 candle has fundamental support that exceeds any previous instance. The 1971 candle had Nixon's decision, but liquid physical markets. The 2011 candle had monetary expansion, but functioning delivery systems. The 2026 candle has monetary expansion, delivery system failure, sovereign accumulation, and supply chain disruption simultaneously. If fundamental support determines mega candle aftermath, the 2026 candle's aftermath should exceed historical precedent. The chart pattern suggests a $1,500 move based on historical averages. The fundamental backdrop suggests the move could extend to $2,000, $2,500, or beyond. The geopolitical dimension adds another layer the chart cannot directly capture. The BRICS nations' gold-backed settlement mechanism, scheduled for pilot testing in Q2 2026, creates demand infrastructure that didn't exist during previous mega candles. When Saudi Arabia can settle oil trades in gold-backed instruments referencing Shanghai prices, the fundamental demand for gold shifts permanently higher. The mega candle may be registering early positioning ahead of this structural shift, institutions accumulating gold before the settlement mechanism transforms who needs gold and how much they need. Russia's gold reserves, over 2,350 tons, the fifth largest in the world, provide backing for BRICS settlement instruments. China's reserves, officially 2,264 tons but estimated at 5,000 to 8,000 tons, including unreported holdings, provide additional backing. The gold flowing into Eastern vaults isn't investment positioning, it's monetary infrastructure construction. The mega candle formed as this construction approaches completion. The technical signal and the geopolitical timeline align. The chart says something changed. The geopolitical calendar says what changed. The global monetary system is being rebuilt with gold as a foundation, and Western markets are just beginning to price this transformation. This is what a system looks like when it runs out of time. The mega candle is a compression event, weeks or months of price action condensed into days. The compression occurs when delayed price adjustment can no longer be delayed. When the dam breaks and water rushes through. Gold's dam was paper market structure, the leverage, the rehypothecation, the multiplication of claims against limited physical supply. That structure held prices artificially stable for years, suppressing volatility that should have reflected underlying supply-demand imbalances. The January 24th mega candle is the dam breaking. Not completely. Paper markets still trade, still quote prices, still function after a fashion. But the structure that prevented price from reflecting physical scarcity has failed enough that a week's trading produced 8 times normal volatility. The water is through the dam. The flow accelerates from here. The trap has no exit for those betting against the candle's message. Short positions in gold and gold equities, held by institutions expecting the rally to reverse, face margin pressure that compounds as prices rise. COMEX Commitment of Traders data shows approximately $47 billion in gross short positions across gold futures and options. These shorts were established at lower prices, under the assumption that gold's rally would exhaust, that paper market structure would reassert control, that the fundamentals didn't support sustained higher prices. The mega candle invalidates these assumptions, technically. Each day prices hold above the candle's midpoint confirms the signal. Each week prices exceed the candle's high, extends the confirmation. The shorts face a choice: cover at losses or maintain positions hoping for reversal. Covering creates additional buying pressure. Short covering is demand, indistinguishable from new long positions in its impact on price. The $47 billion in short positions represents latent buying demand that activates when conviction in the short thesis breaks. Historical analysis suggests mega candles trigger short covering cascades within 30 to 45 days of formation. The shorts resist initially, hoping the signal is false. They resist as prices consolidate, interpreting sideways action as reversal potential. Then prices break to new highs, the resistance breaks with them, and covering accelerates price appreciation. The cascade timing is uncertain. It depends on pain thresholds and margin capacity that vary by institution. But the cascade is likely. The mega candle's message is too clear, the fundamental support too strong, the technical confirmation too consistent. The $50 to $5,000 framework depends on selecting instruments that capture both the gold rally and the leverage the mining sector provides. Physical gold holders participate in the underlying move, meaningful returns, but not the exponential returns the framework describes. Leveraged ETFs, 2x and 3x products that amplify daily gold moves, offer mechanical leverage but suffer from volatility decay that erodes returns over multi-week periods. Useful for short-term trading, problematic for capturing full mega candle aftermaths. Mining equities, particularly junior miners with projects that become economic at higher gold prices, offer fundamental leverage without volatility decay. The leverage is operational rather than financial. Higher gold prices translate to higher profits and higher valuations through business economics rather than derivative structures. The selection challenge is identifying which juniors will succeed. The sector's failure rate is high. Many promising projects never reach production. Many management teams lack the capability to execute. Many jurisdictions where deposits are located carry political risk that can negate any commodity price benefit. The solution is diversification. Not one $50 position, but 10 $5 positions, accepting that half will fail while hoping 2 or 3 capture the mega candle's full potential. The basket approach reduces single-name risk while maintaining exposure to the sector's leverage. The question is not whether the mega candle's message is valid. The technical signal and fundamental support both confirm it. The question is execution. Which instruments, which timing, which position sizes translate the signal into returns that justify the analysis? Those who understand the pattern are not waiting for additional confirmation. The mega candle itself is the confirmation, the largest single-week move in 13 years, backed by fundamental conditions stronger than any previous mega candle enjoyed. The 60-day window ticks whether positions are established or not. Each day that passes without positioning is a day less remaining to capture the pattern's core opportunity phase. The early movers are already in. The late movers are running out of time. Reality asserts itself through price action that cannot be argued with. The chart shows what happened. The candle measures what the market did. The volume confirms participation. The historical parallels suggest what follows. None of this guarantees outcomes. Markets can confound any pattern. Fundamentals can shift in unexpected directions. The mega candle could prove to be a blow-off top rather than a trend initiation, despite conditions suggesting otherwise. But the weight of evidence, technical, fundamental, historical, points in one direction. Up, significantly. Within a time frame measured in weeks, not years. The $50 to $5,000 framework is not investment advice. It's illustration, showing what becomes mathematically possible when a confirmed trend combines with leveraged instruments that amplify the underlying move. The mega candle printed January 24, 2026. The clock started that Friday. 60 days extends to late March. The window for capturing maximum opportunity narrows each day. The chart speaks clearly for those who know how to read it. One green bar, larger than any in 13 years, backed by fundamentals stronger than any previous instance, pointing toward price targets that seemed implausible until the candle made them calculable. The candle says something changed. The something is visible in LBMA failures, COMEX stress, Shanghai depletion, and central bank accumulation. The change produces price adjustment. The adjustment is just beginning. Mega candle. 60 days. Leverage instruments that multiply the move. The math works. The history supports it. The fundamentals confirm it. What remains is action. The candle already printed. The opportunity window already opened. The countdown already started. $50 or $5,000. The difference is understanding what the candle says and positioning before the 60 days expire. The chart told us everything we need to know. The rest is execution.